I want you to understand a shift that most investors are still not seeing clearly. Everyone is watching the obvious part of the AI boom. They are watching chips. They are watching Nvidia. They are watching models. They are watching data centers from the outside as if the only scarce thing in the system is computing power. But there is another constraint sitting underneath all of it: electricity. AI does not run on imagination. It runs on power. It runs on transmission lines, substations, transformers, cooling systems, switchgear, fuel, gas, uranium, copper, aluminum, and physical infrastructure that most investors consider boring until the shortages become impossible to ignore. This is one of the great principles in investing when everyone is looking at the shiny thing. Look at what the shiny thing consumes. AI consumes power, and America's power grid was not built for this. The grid was built for a different era. It was built for households, factories, air conditioning, refrigerators, televisions, and a more predictable electric demand curve. It was not built for AI data centers running 24 hours a day with industrial-scale energy needs. A data center is not a normal building. It does not sleep at night. It does not take weekends off. It cannot simply shut down when the wind stops blowing or when the sun goes down. It requires constant, stable, high-quality electricity. That is where the problem begins. The power demand from AI data centers is enormous and rising quickly. The source makes the point dramatically. Today, AI data centers require power comparable to tens of millions of homes, and by 2030, that demand could more than double. Whether you debate the exact number is less important than understanding the direction. The direction is undeniable: more AI models, more servers, more chips, more data centers, more heat, more cooling, more electricity, more grid strain. The physical world is becoming the bottleneck for the digital world. That is the opportunity. Most retail investors are trained to chase stories. They hear about a technology, then they buy the most visible stock attached to it. Institutional investors often do something different. They follow the money. That phrase sounds simple, but it means something very specific. You do not follow what people say might happen. You follow what capital is already doing: contracts, backlogs, permits, government programs, utility spending, capex budgets, long-term purchase agreements, stock price leadership, and sectors tied to actual spending. Money does not need a convincing story. Money moves because decisions have already been made. This is why the grid build-out matters. The source argues that a major executive order and government policy push are redirecting large amounts of capital into grid reliability, power generation, and energy infrastructure. The exact political framing matters less than the financial mechanism. If AI power demand is rising and the grid cannot handle it, someone must spend money. Utilities must spend, data centers must spend, the government must spend, contractors must build, component suppliers must supply, fuel providers must fuel. Cooling companies must cool. Transmission companies must upgrade. That is the chain. If you want to understand an investment theme, do not stop at the headline. Trace the chain of spending. The first idea is that AI is breaking the grid, not in the sense that everything stops tomorrow, but in the sense that the existing infrastructure is not adequate for the load that is coming. Many transformers are old. Transmission capacity is limited. Interconnection queues can take years. Permitting is slow. Utilities cannot move at the speed that AI companies want. AI companies do not think in 5-year utility timelines. They think in quarters, model releases, product launches, and competitive races. If a large technology company needs power for a data center and the grid cannot deliver it quickly enough, the company has two choices: wait or build its own power. Increasingly, it chooses to build. That is a structural change. Private companies are becoming power developers because power is now strategic infrastructure. In the past, a data center company connected to the grid and bought electricity like a customer. Now some of them are building or contracting dedicated power sources near their facilities. This is why off-grid and on-site power generation becomes important. Fuel cells, natural gas generation, small modular nuclear reactors, dedicated power plants, long-term power purchase agreements. These are no longer side stories. They are becoming part of the AI supply chain. The next principle is that the government is stepping in because grid failure has become a national competitiveness problem. AI is not only a technology story. It is a national security story, an economic story, an industrial policy story, and a military capability story. If the United States cannot power its data centers, it cannot fully lead in AI. That gives the government an incentive to accelerate grid reliability and power capacity. The source describes an executive order focused on grid reliability and security, emergency powers to prevent grid failures, and fast-tracking certain power agreements for military and critical facilities. Whether you agree with the policy or not, the investment question is different. Who benefits from the spending? That is the question. The order can keep coal and gas plants operating if the system cannot afford to lose capacity. That matters because dispatchable power is valuable. Solar and wind have roles, but they are intermittent. Data centers need power all the time. If the grid is strained, dispatchable sources become politically and economically more important. This is not an ideological point, it is an operational point. If the power must be available 24 hours a day, The system needs sources that can deliver 24 hours a day or storage and grid capacity sufficient to make intermittent sources reliable. That creates demand for gas, nuclear storage, transmission, and grid management. The source also emphasizes power purchase agreements. These are long-term contracts to buy power. They may sound boring, but boring contracts can be very valuable. A company with a long-term power purchase agreement may have predictable revenue for 10, 15, or 20 years. Investors should pay attention to that. Predictable contracted revenue can reduce uncertainty. It can support financing, it can justify capital investment, it can turn an idea into a cash-flowing project. That is why contracts matter more than press releases. A press release can be narrative, a signed contract is money. This brings us to one of the most important metrics in the whole theme. Backlog. A backlog is work a company has already sold but has not yet completed. It is not a forecast, it is not a hope, it is not a management fantasy about what might happen. It is signed business waiting to be executed. When a company has a large and growing backlog, it tells you that demand has already shown up in a concrete form. The source gives Quanta Services as a key example. Quanta is one of the largest grid infrastructure contractors in North America. It builds transmission lines, substations, and other grid infrastructure. The source cites a backlog around $44 billion. That is important because it represents years of work. In a cyclical economy, revenue can fluctuate, but a large backlog provides visibility. It tells investors that the company has projects already lined up. It also tells you that utilities, governments, or private customers are committing capital. This is how you follow the money. Do not simply ask, is the power grid an important theme? Ask, which companies have signed contracts and backlog tied to that theme? That second question is much more useful. The first major beneficiary category is off, grid power generation. If data centers cannot wait 5 to 10 years for grid connections, they will build or contract power directly. That creates opportunities for companies that can provide on-site or dedicated power solutions. One example in the source is Bloom Energy. Bloom makes fuel cells. In simple terms, these can operate like on-site power generators using natural gas or other fuels for a data center that needs reliable power without waiting for major grid upgrades. On-site generation can be attractive. The source mentions a major deal with Oracle and notes that Bloom's stock had already risen sharply over 6 months. That price movement itself is information. When a stock tied to a specific theme rises much faster than the broader market, it may indicate that institutional capital has already identified the flow of money. That does not mean the stock is always still a buy. It means the theme is real enough that capital has been reacting. Another example is Oklo. Oklo is tied to small modular nuclear power. The idea is that smaller nuclear reactors may eventually provide reliable carbon-free baseload power for facilities like data centers. Technology companies are interested because nuclear power can run continuously and can be described as clean in carbon terms. The source connects Oklo with large technology demand and broader interest from companies like Microsoft, Amazon, and Google in nuclear-related solutions. This is a speculative area. Small modular reactors are promising, but execution, regulation, permitting, cost, safety, public acceptance, and timing all matter. Investors must distinguish between an exciting long-term theme and a company's ability to deliver actual projects on schedule and on budget. Nuclear is not easy. But if AI power demand keeps rising and the world wants low-carbon baseload power, nuclear will remain part of the conversation. If nuclear grows, uranium becomes important. The source mentions Cameco as one of the world's largest uranium suppliers. This is the picks and shovels logic. If more nuclear reactors are built or existing reactors remain online longer, uranium demand can rise. If supply is tight because the world underinvested in uranium production for years, prices and uranium producers may benefit. Again, the idea is not to buy anything blindly. The idea is to understand the chain. AI needs power. Power may require nuclear. Nuclear requires uranium, therefore. Uranium suppliers may become part of the AI infrastructure trade. That is how second-order thinking works. The second opportunity category is the physical grid builders. These are companies that build the infrastructure that must exist if the grid is upgraded. Transmission lines, substations, pipelines, power plants, electrical systems, and mechanical contracting. Quanta Services is a central name in the source because it is a major contractor for transmission and grid work. Its backlog and project visibility make it a way to participate in physical grid spending. Mastech is another name mentioned. It builds pipelines and power lines that matters because the energy transition and AI power demand are not only electrical, natural gas infrastructure may also be needed if gas-fired plants are used to provide reliable power for data centers and grid stability. Argon is described as a power plant contractor. If new generation capacity is needed, companies that design and build power plants may receive contracts. Comfort systems is mentioned for mechanical and electrical contracting for data centers. Data centers need specialized cooling, electrical systems, installation, and ongoing infrastructure. Companies that execute this work can benefit from the capital spending boom, even if they are not pure AI companies. This is the pattern. The obvious AI winners may be chip companies. The less obvious winners are the companies that make AI physically possible. That includes power, cooling, contracting, and grid infrastructure. The third opportunity category is specialized electrical components. This may be the most interesting layer because it is even deeper in the supply chain. Every data center substation, power line, and power plant requires components: power modules, switchgear, circuit boards, cooling systems, transformers, electrical distribution equipment. There are often high barriers to entry because these components require engineering expertise, reliability, certification, and manufacturing capability. When demand rises quickly and supply is specialized, the companies that make critical components can see strong pricing power and backlog growth. The source mentions Viker, which makes power modules used for power conversion. AI chips and advanced computing systems require efficient power conversion. As compute density rises, power management becomes more important. It also mentions Powell Industries, which makes switchgear and electrical distribution equipment. Think of the equipment that controls and protects the flow of electricity. In a world building more data centers and grid infrastructure, switchgear demand can rise significantly. Vertiv is mentioned for thermal management and cooling systems. AI chips generate tremendous heat. Traditional cooling is not enough for many high-density AI systems. Specialized cooling, liquid cooling, and thermal management become critical. This is another important principle. When compute density rises, heat becomes a constraint. When heat becomes a constraint, cooling becomes valuable. AI is not just software, it is thermodynamics. The source also mentions other component and electronics names, such as TTMI and AEIS. The specific tickers matter less than the concept. The component layer can benefit because every major build-out requires specialized hardware. The fourth category is raw materials. You cannot rebuild a grid without physical inputs. Transmission lines need aluminum and other conductors. Electrical systems need copper. Transformers need metals and specialized materials. Nuclear requires uranium. Data centers require steel, concrete, cables, power equipment, and cooling systems. Raw materials are often overlooked because they are not glamorous. But when a physical build-out accelerates, materials can become bottlenecks. The source highlights aluminum, including companies such as Century Aluminum and Alcoa. The argument is that if the grid requires large amounts of aluminum and policy supports domestic production through tariffs or American-made requirements, domestic producers may benefit. This is a different type of opportunity. It combines infrastructure demand with trade policy. If the government wants the grid rebuilt using domestic labor and materials, the beneficiaries may include companies that produce the required materials inside the country. But raw material plays are cyclical. Commodity producers can move dramatically based on prices, supply, energy costs, global demand, tariffs, and political changes. These are not stable compounders in the same way as some high-quality businesses. They require discipline and an understanding of cycles. The fifth category is the infrastructure platforms and second chance entry opportunities that appear after the first wave of a theme has already moved. This is where many retail investors get confused. They see a stock up 50%, 100%, or 200% and assume the opportunity is over. Sometimes it is. But in large structural cycles, early moves can be followed by much larger moves if earnings, backlog, and policy support continue to improve. Institutional investors do not always need to be first. They often prefer being a little late but with more confirmation. That is a very important idea. Being early can create large gains, but it also creates higher uncertainty. You may buy before the contracts, before the policy, before the revenue, before the market recognizes the theme that can be profitable but also dangerous. Being a little late means you may miss the first part of the move, but you may gain more evidence that the trend is real. The source uses examples of stocks that looked extended but continued rising because the underlying trend kept strengthening. The lesson is not to chase everything that has already gone up. The lesson is to study whether the move is supported by accelerating fundamentals. Is backlog rising? Are contracts increasing? Are margins improving? Is policy support expanding? Are customers spending? Is the industry capacity constrained? If yes, a stock can continue moving even after a strong run. If no, the move may be only speculation. This is where risk management matters. A theme can be right and a trade can still be wrong if the entry price is too high, the position size is too large, or the investor cannot tolerate volatility. Now let us step back and look at the evidence of money flow. The source notes that while the broad S&P 500 had moved only modestly over a period, power line construction companies, engineering and construction companies, electronic component companies, and certain individual names had risen dramatically. This is what relative strength looks like. When a sector outperforms strongly while the broad market is flat, it tells you that capital is rotating. It does not prove that the move will continue, but it is a signal. Institutional money often moves before the mainstream story becomes obvious. By the time the news explains the theme, the early price movement may already have happened. This is why you must watch data and price, not only headlines. The data was public, the executive order was public, backlogs are public, quarterly reports are public, stock prices are public. The issue is not that the opportunity was hidden. The issue is that most people were watching the wrong screen. They watched news narratives, the money watched contracts and flows. That is the difference. Now, I want to give the framework in a way that can be reused. The first step is to zoom out and identify an undeniable trend, not a vague prediction, not a story. People hope will happen, a trend that is already happening at a scale too large to ignore. In this case, AI data center power demand is rising. The grid is old, interconnection delays are long, utilities and technology companies must find power. The government is supporting grid reliability and energy infrastructure. These are observable facts. The second step is to ask who benefits from the trend. Do not only ask who is most famous, ask who gets paid. If AI needs power, the beneficiaries may not only be AI software companies, they may be fuel cell companies, nuclear developers, uranium miners, grid contractors, pipeline builders, power plant constructors, switchgear manufacturers, cooling companies, power module producers, aluminum producers, and electrical equipment companies. The third step is to look for evidence of real money backlogs, signed contracts, revenue visibility, government awards, utility capex plans, power purchase agreements, customer concentration project timelines, earnings revisions, capital spending. That is how you separate a story from a cash flow opportunity. The source emphasizes backlogs because they show work already sold. That is a good instinct. Revenue projections can be optimistic. Backlog is more concrete. It still has risks, but it is stronger than a vague forecast. The fourth step, which I would add explicitly, is to understand valuation and risk. A company can benefit from a trend and still be overpriced. A stock can rise because investors anticipate growth. But if expectations become too high, even good results may not be enough. You must compare price to future cash flow, margins, balance sheet strength, execution risk, and cyclicality. Do not confuse a good theme with a good investment at any price. That mistake destroys people in every boom. The fifth step is position sizing. Infrastructure themes can be powerful, but many companies tied to them are cyclical, capital intensive, or volatile. A contractor can have project execution risk. A fuel cell company can have profitability risk. A nuclear developer can have regulatory and financing risk. A uranium supplier can be tied to commodity prices. A component maker can suffer if demand slows or competition rises. So you size the position according to the risk. You do not make one theme your entire financial life. A well-structured portfolio can include a theme without being dominated by it. That is how serious investors survive. Now let us talk about each layer with more discipline. Off. Grid power generation is attractive because it addresses the immediate pain point. Data centers cannot wait for the grid. But the companies in this layer can be speculative. Fuel cells require margins, manufacturing scale, fuel availability, and customer adoption. Small modular nuclear requires licensing, financing, construction, safety approval, and long timelines. These are not simple businesses. The upside can be large because demand is large. The risk can also be large because execution is hard. Grid builders may have more visible demand because utilities and governments must spend regardless of which specific power source wins. Transmission lines, substations, and grid upgrades are required across many energy scenarios. That can make companies with large backlogs attractive, but construction companies can face cost overruns, labor shortages, project delays, and margin pressure. Component suppliers may have pricing power if their products are critical and capacity constrained, but they can be cyclical. If the capex cycle slows, orders can fall. If competitors enter, margins can compress. Raw materials can benefit from structural demand and policy support, but commodities can be volatile. Supply can come online, prices can overshoot and then fall. Investors need risk controls. This is why the framework is more important than the ticker list. A list can become outdated. A framework lets you keep updating. The source mentions many names, but the real lesson is how to think. AI creates power demand. Power demand creates grid stress. Grid stress creates government and private spending. Spending creates contracts. Contracts create backlog. Backlog creates revenue visibility. Revenue visibility attracts capital. Capital movement creates sector leadership. Sector leadership creates investor attention. Investor attention can create both opportunity and overvaluation. That is the causal chain. When you understand the chain, you can identify where you are in the cycle at the beginning. The trend is ignored and risk is high. In the middle, contracts appear and the market begins to price the theme. Later, everyone knows the story and valuations may become stretched. The best opportunities often appear when the data is public, but attention is still limited. That is the key sentence. The data is public, but attention is limited. Most people think the market hides opportunities. Sometimes it does not. Sometimes the opportunity is visible, but investors are distracted by more exciting narratives. The grid is not exciting in the same way. AI chips are exciting. Transmission lines do not create the same emotional response as artificial intelligence models. Transformers and switchgear do not sound like the future, but the future cannot operate without them. This is the advantage of thinking in second-order terms. The crowd wants the glamorous layer, the money often flows to the necessary layer. Now, there is another important point. Policy can accelerate a trend, but it can also create political risk. If an executive order, government funding, tariffs, or energy policy supports a sector, that can help companies. But policies can change, elections can change priorities, permitting can remain slow, legal challenges can appear, budget processes can delay spending. So policy support is not certainty, it is a tailwind. A tailwind helps, but the company must still execute. This is why you look for companies with existing business, existing backlog, and existing customer relationships rather than only companies that need policy to survive. A company that benefits from policy but does not depend entirely on it is often stronger than one whose whole story requires government support. That distinction matters. The source also talks about tariffs on foreign metals and the potential benefit for domestic aluminum producers. That is a clear example of policy interacting with industrial demand. If domestic sourcing becomes more important and infrastructure spending rises, domestic producers may benefit. But tariffs can also raise costs for downstream users, create retaliation, and change market dynamics. So even policy benefits have second-order effects. Serious investing always asks, and then what? If tariffs help producers, what happens to costs for builders? If costs rise, do margins compress? Can contracts pass through costs? Do customers delay projects? If government spending accelerates demand, can labor supply keep up? If everyone wants transformers, how long are lead times? If data centers build their own power, what happens to utilities? If nuclear demand rises, how long before new supply arrives? These questions create a better map. Now, how should an ordinary investor approach a theme like this? First, do not chase only because a stock has risen. A rising stock is a signal, not a command. Second, build a watch list by category: power generation, grid contractors, components, cooling, materials, utilities, and independent power producers, nuclear and uranium data center, infrastructure. Third, study the financials: revenue growth, backlog growth, margins, debt levels, free cash flow, customer concentration, project risk, CapEx requirements. Valuation. Fourth, compare relative strength. Which stocks are outperforming the market? Which stocks are outperforming their own sectors? Which stocks are rising on earnings and contracts? Not only hype. Fifth, wait for entries that make sense. Even strong themes have pullbacks. Stocks do not move in straight lines forever. If you miss the first move, that does not mean you must buy emotionally. There will often be second chances, especially in volatile sectors. Sixth, diversify within the theme. If you do not know the exact winner, you may not know whether fuel cells, nuclear gas transmission, or cooling will produce the best returns. A basket approach can reduce single company risk, but do not diversify into weak companies just because they belong to the theme. Quality still matters. Seventh, define your exit or review criteria. If backlog stops growing, reassess. If valuation becomes absurd, reassess. If policy support disappears, reassess. If execution fails, reassess. If the company dilutes heavily, reassess. If the thesis changes, do not cling to the old story. Markets reward flexibility. This is where the source S rotation idea matters. If the theme continues, stay with the trend. If it stops working and the data changes, rotate out and find the next area where capital is flowing. But be careful, rotation is not random trading, it requires a system. Without a system, rotation becomes chasing. With a system, rotation becomes capital allocation. The difference is discipline. Now let me bring the macro view back into the picture. AI power demand is not a small cycle if it continues. It may be one of the defining infrastructure challenges of the decade. The United States wants to lead in AI. Technology companies are spending hundreds of billions on data centers and compute. The power grid is old. Transmission is constrained. Energy policy is shifting. National security concerns are rising. Industrial policy is returning. This combination can create long investment cycles. Long cycles do not move in straight lines. There will be corrections, political fights, project delays, financing issues, and overhyped stocks. But the underlying need for power is not going away if AI continues scaling. That is why the power layer deserves attention. It is the hidden denominator of the AI boom. Every model training run, every inference workload, every server cluster, every GPU, every cooling system, every facility needs electricity. If electricity becomes scarce, expensive, or delayed, it shapes the economics of AI. That means the energy and grid system is no longer separate from technology investing. It is part of technology investing. This is the mental model many investors need to update. Technology used to feel asset-light. Now the next phase of technology is intensely physical chips. Fabrication plants, data centers, power plants, transmission lines, cooling systems, water land permits, material supply chains. The digital economy is becoming more dependent on physical infrastructure, not less. That creates opportunities in old economy companies that suddenly become critical to new economy growth. This is often where major investment surprises occur. The market initially rewards the visible innovators. Then it begins to reward the suppliers, builders, and bottleneck owners. The bottleneck owners can sometimes capture enormous value. If everyone needs transformers and transformer supply is limited, transformer makers gain power. If everyone needs cooling and only a few companies can deliver it at scale, cooling companies gain power. If everyone needs grid construction and only certain contractors have the scale and labor force, those contractors gain power. If everyone needs uranium and supply is tight, uranium producers gain power. This is not about slogans. It is about bottlenecks. Follow the bottleneck. That is another way to say follow the money. Now, I want to be clear about risk because every hot theme attracts bad behavior. Once retail investors notice a theme, promotional activity rises. Companies attach themselves to the narrative, small firms announce vague partnerships. Stocks move on words rather than orders. Valuations expand. People start saying the move cannot stop. That is usually when discipline becomes most important. The grid theme may be real. That does not mean every grid-related stock is good. The AI power shortage may be real. That does not mean every fuel cell, nuclear, uranium cooling, or component company will make investors money. Some will underperform. Some may dilute shareholders. Some may overpromise. Some may lose contracts. Some may be priced too richly. Some may be cyclical at exactly the wrong time. So your job is not to believe. Your job is to evaluate. A good investor can be bullish on a theme and still cautious on a specific stock. A good investor can like a company and still wait for a better price. A good investor can own a position and still admit when the thesis changes. That is how you survive. The final lesson is that the market is always moving money somewhere. Even when the broad index is flat, some sectors are rising and others are falling. If you only watch the index, you may think nothing is happening. But under the surface, rotations occur constantly. Institutional investors track these rotations. They look at relative strength, they look at earnings revisions, they look at capital spending, they look at backlogs, they look at policy changes, they look at supply constraints, they look at which companies are getting paid. Retail investors often wait for the news to summarize the story after the move. By then, the first part is gone, but that does not mean the opportunity is gone. In large cycles, there may be many stages. The key is to understand where the money is moving now and where it may move next. That is the skill. Not memorizing a list of tickers, learning to identify the causal chain before the crowd fully understands it. So if you look at this AI power and grid theme, do not only think, which stock should I buy? Think in the full structure. AI demand is rising. Data centers need enormous electricity. The grid is old and constrained. Interconnection delays force private power solutions. Policy support accelerates spending. Backlogs reveal real demand. Grid builders execute the physical work. Power providers supply dedicated generation. Component companies supply critical equipment. Cooling companies solve heat. Materials companies supply the raw inputs. Stocks that lead may show where capital is flowing. Valuation and risk determine whether the trade is still attractive. That is the system. If you understand the system, you are no longer dependent on someone handing you a ticker. You can do the work yourself. You can watch the quarterly reports. You can compare backlog changes. You can track contracts. You can see which companies are raising guidance. You can observe relative strength. You can identify second chance entries after pullbacks. You can separate real spending from hype. That is the difference between speculation and informed investing. Speculation asks, what sounds exciting? Informed investing asks, where is capital being committed? Who captures it? What is priced in? And what are the risks? That is how I would think about this moment. The AI story is no longer only about chips. It is about power. It is about grids. It is about physical infrastructure. It is about the companies that will build, supply, cool, connect, and fuel the next layer of the digital economy. Most investors may still be watching the surface. The money has already started moving beneath it. And if you want to understand where the next opportunities are, follow the money, follow the bottlenecks, and follow the contracts. Not the noise. The contracts, that is where the truth usually shows up first.